Hi, welcome to my channel. How are you? Everything's good. Okay, today's topic is IFRS 15. Today we will talk on this topic IFRS 15, which is revenue from contract. It was IAS 18 and IAS 11, but it was being replaced by IFRS 15. I will give you the overview before I do the practice and do the question. um, we will There are 5 stages we will study in this standard. First stage is the first stage is identify the contract. First we will have to identify if there is a contract or there is not a contract. Second, we will identify the performance obligation, if this contract has one single obligation or it has multiple obligation or more than one or two obligation. And then we will adjust the price. We will see how much price we're gonna get from out of this contract. And number 4 stage is we will allocate the price to the multiple or to the multiple obligations, and then accordingly we will book the revenue. So this is our first stage is we will discuss in deep now. The first stage is identify the contract. First we will have to see if there is a contract or not. So there are 3 type of contract. There is one in written, as a written contract. If you and me are in contract, and we sign the deed, contract deed, it means we are in a contract now. So it's a written contract. Verbal contract is the example of the verbal contract is if I promise you that I will pay you 500. So any contract which is legally binding. So we will discuss the other features as well. First I'm just giving you different type of contracts. One is verbal or words by words. The second one is by written, and the third one is by action. By action mean that like suppose if I have a business of smartphones, I have a shop of mobile phone, so you are my like client or a distributor. So when you come in my shop, you just pick suppose you pick my iPhone 6 and you just show it to me, and you left the shop and you have taken my iPhone 6. It means for me I can consider this as a sale. So because we have a mutual understanding that whenever you come, you just pick the thing and you show me that this is I'm taking out. So it means for me I can consider this as a sale. If you come in my shop and you pick iPhone 11, so you just showed me that I'm taking this iPhone 11, and you just go out from to the shop, and from the shop, and you took the phone. It means for me I will consider this as a sale. It's a contract. So by the action. So first thing is we need to identify the contract, whether the contract is actually a contract or not. So these are 3 things which is compulsory to have a contract. So identify the contract. First we need to identify if it is a contract. Then we have to identify the terms of contract, like if I say I will need for against this mobile I need 5,000, or I will give you iPhone 11 in 500, and then I must agree and you must accept. I must offer and you must accept, as we have already studied in the law. So this is the identifying the contract. Any contract which is legally binding or right to sue, like if I breach the contract, then you can legally sue me. You can legally enforce it. So this is a contract. The third one is probable chances of economic benefit. Out of this contract you will have a probable chances of economic benefit. With this contract you will get chance of economic benefit. This will give you the benefit of economic benefit. Like by doing this contract, suppose if I do a contract with you for iPhone 11, it means when I give you the phone, you will have you utilize this life. So this phone belongs to you. this phone you can use, and then you can take a economic benefit from that phone. So these are the terms which identify the contract. These are the terms which identify there is a contract. One stage has done. When we identify this is a contract, then only we go to the next stage. The next stage is stage 2 is identify performance obligation. So I already wrote it, so just to save time, there are two type of performance obligation. Performance obligation means your liability. So either you will have separate performance obligation or single obligation. I'll give you the examples. So anything which is provided separately and benefited separately, this is most important thing, very important thing. Anything, I'll give you the example of separate performance obligation. Separate performance obligation, like I'm a shopkeeper, I sell generator and maintenance. I sell maintenance and generator. So in this example I will say the generator, the moment you buy me a generator from me, you came to my shop, you said I want to buy this generator, I'll give you the price of 5,000. So I will tell you that if you pay me like 5,000, if you want the maintenance, I will give you in 600, I'll give you maintenance and generator both. So how many? It means the generator, you can get the generator, you can buy the generator from outside, and you can get the maintenance from outside, from somewhere else. It means these are provided separately. And if you take only a generator from me and you take a maintenance from outside, or you buy the generator from outside but you just take a maintenance from me, it means benefited separately. So if these two conditions are met, then only we can say it's a separate performance obligation. Like provided separately, if these things are provided separately in the market, or the second is the benefited separately. So you have to get the benefit separately. Either if you buy a generator from me, it means only generator being alone give you benefit. So it means you can either get the benefit from outside or from me. You get my point? It means provided separately and benefited separately. If these conditions are met, it means this is a separate performance obligation, two performance obligation. If you buy generator and maintenance from me, then it means I will have two performance obligation. I am obliged, I have a liability to give you the generator plus a 2-year service cost maintenance. Same as the second example is mobile and SIM card. Like in UK, you can get a SIM, then they will give you the phone for free. Or you can say in a contract you pay £50 with the most SIM, plus you're gonna get the phone as well. So it means it's a benefit separately, because if you buy only a mobile from me, it will give you the benefit. Or if you buy a SIM from me, it will still give you a benefit isolation. If you buy from both from me, or if you buy a single from me, either a mobile or a SIM, in either way you're gonna get the benefit. So it means it's a benefited separately. And the same goes that you can buy a mobile from anywhere, or you can buy the SIM separately anywhere. So it's provided separately and benefited separately. So for me it's a two obligation. Same as car and warranty. Sometimes when you buy a car, they said the car warranty is 1 year, but if you pay me 100,000 more, I'll give you 5-year warranty. So either you can get the car from me, or you can buy the car from outside, or either you can buy warranty from me, or you can buy the warranty from outside. It means these are provided separately. or benefited separately. If you buy a car from me, it will give you the benefit, or if you buy only a warranty from me, it will give you only the benefit. So it means in either case is these conditions are met, provided separately and benefited separately. So for me it's a two different obligation. Now I'll give you the example of one or single entity, single obligation. Single performance obligation example is construction of a house. Like because the thing is, when if I do a contract with you that I will build you a house, I will construct a house for you, but after making one wall, I backed off. I said no, I'm not gonna make it. If I breach the contract, it means being from one wall you cannot get the benefit. So it's not a benefit is separately. So single wall cannot give you the benefit. Only a full house will give you the benefit, not a single wall. Like single wall cannot give you the benefit. That is why it's a performance obligation, single performance obligation. My obligation is to build a home, a full house, then only you will get the benefit. So this is a single application. Now this one we have already discussed, identification of contract. Now we have done identification of performance obligation. Now let's talk about transaction price. Transaction price means what I will get out of this, what I will have the price. There are two aspects. One is fixed price and the second one is variable price. The fixed price is I give you the contract that I will make your house, I will build a house for you, I will take 100,000, a fixed price. So standard gave you the permission, you can book the revenue as 100,000, because for me that I have already got the promise from you. Or you can say you buy from me an iPhone, and then iPhone 11 I give you the price of 1,000, and you said okay, it's a fixed price. So it means if you, when you agree, then I can book a revenue because you agree it's a fixed price. The second one is, the second category in transaction price is variable price. Variable price is where you're not confirmed, you did not confirm the price. Like if you, I can show you in, I can give you the example like this. You are my employee, so what I'll do is I will tell you that if you give me 500k profit, if you give me 500k profit, I will give you 50% extra bonus, extra salary bonus, 50%. It means if your salary is 1000, I will give you 1500. But if you give me profit of 500,000, it means 1000 is fixed, this 500 extra 500 is a variable. There is a condition, if you meet this condition, then only you will get this 500. Previously IAS 18 they were not giving you permission to book the revenue, but IFRS 15 they are allowing you to book the revenue. So if you say I'll give you the example here. So you can book the revenue up to the extent where reversal is impossible. So in variable price you can book your income, your revenue up to the extent where reversal is impossible. I give you the example here, I just already wrote it down. So I gave you the condition, if you give me 100,000 profit, I'll give you 10,000. I will give you 10,000. But if you give me 500,000 profit, I'll give you 20,000 by December. And in the middle, in July, you figure out yet you made 150k. So it means because of 150, this condition being met, this condition has been met. So it means in either case you secured your 10,000 there. In this way the reversal is impossible. So this you can book the revenue. You can book a revenue for this variable because it's fixed now, because you are pretty sure that you're gonna get your sale is 150 and your target was 100,000 for 10,000 commission, so you made 150k, so it means this is pretty sure, so you can book this as a revenue. But you cannot book this as a revenue until you are confirmed. So reverse, where you can only book a revenue where the reversal is impossible. There are second thing there is second thing is sale on return basis and their treatment. Sale on return basis, it means if I buy iPhone, I come to your shop and you are a shopkeeper. I come to your shop, I said, okay, can I have iPhone 6? Okay, then I said, if I'm gonna keep this iPhone 6 with me for 6 months, but if am unable to sell this phone, I will come back and I will return this phone to you and I will take my 1000 back. I'll give you the example. I come to your shop, I say, I want to buy iPhone 6. You said 1000 price. I said, okay, I am taking your phone, iPhone 6. I'm gonna keep this phone for 6 months. If nobody purchase this phone from me, if I am unable to sell this phone, then I will come back to your shop and I will return your iPhone 6 and I will take my 1000 from you. So technically it's not a sale. You can say it's not a sale, it's not a genuine sale. We will consider this as a loan. It means I'm giving you are just giving me a phone and you're taking 1000 from me, and after 6 months you will gonna get your phone back. So it's not a technically, it's not a sale, it's a loan. And we have already studied where where it is a significant difference of amount or difference of time, then if any liability is more than 12 months, we calculate or we write down into present value. We calculate present value for that liability, any liability which is more than 12 months, so we write it down in present value. So any material difference between time of service or time of payment. So anything which is time of payment or time of any difference is more materialistic time difference, then we will calculate as a present value. I'll give you the example. Provide service now and taking payment after 2 years. Okay. Well, if you approach me, you said, can you uh, can you please give me tuitions now? I'll give you payment after 2 years. I said, okay, I have a contract with you. I will teach you now, but I will take my payment after 2 years. Then I will tell him that if you pay me now, I will charge 10,000. But if you pay me in after 2 years, because it's a material difference, then I will calculate the present value. But after 2 years, I will take 12,500, 12,100. I will not take 10,000. It means that the present value of future cash flow is 10,000. If you pay me now, I will take 10,000. But if you pay me after 2 years, I will take 12,100 instead of 10,000. How we will book this revenue? On 0, on year 0 I will have an entry like this. It means it's a receivable for me. I know that after 2 years I will have to receive this. So receivable debit 10,000, and credit is sales. That is a sale, credit sale. We will consider it as a credit sale. I will consider this as a credit sale. By the first year, by 12 month, I will calculate the present value. So if you take interest rate is 1%, 10%. If you take 10% of this, it means you will have 1000 as interest. So I will pass the entry receivable. Again I will book a receivable 1000 to interest income, because it's an income for me. So by the first year I will have 10,000 plus 1000. It means I will have 11,000. At the first year I will have 11,000 receivable, and the same goes here. When I do this, I will give you the second year service. I will book same entry again. Then the receivable was 11,000 before. Now if you see, now take a 10% of 11,000. It means 11 this. If you book 1100 this. So first year take a 10% on this value, then add 10,000 plus 1000, 11,000 here, 11,000. Then take a 10% on the second year, take a 10% on 11,000, which is this. So 11,000 plus 1100. It means after 2 years the cash flow will be 12,100. The second year entry will be receivable debit 1100 to interest income, again profit and loss 1100. At the year end here, at the final year, I will pass a entry. I will pass one entry. It means after 2 years I will have a cash or bank debit. It means asset is increasing. We will debit 12,100. It means we need to reverse this entry receivable. This receivable. We need to reverse this receivable, and this receivable. So 10,000, 1100 and 1000 mean 12,100. So the receivable means that we will receive this, and now today we have already received it. So it was debit before. Now to reverse it, we will credit this receivable 12,100. Asset is decreasing, that's why it's credit. Okay, you get my point. Previously we were increasing the receivables. Now we have received the cash debit, and now we will reverse this receivable. So we will reverse this receivable. The second example now. So this is you understood, right? Now the thing is, what if I say I will pay you let me rub this. What I will do is, now I will change the question. Now I will say case 2. What if you pay me now? I will give you the service in 2 years. I will reverse this question. Previously what I say, I will give you the service now, I will teach you now, and after 2 years you pay me. But now in this question I will say I will you pay me now and I will give you service in 2 years. How we will accommodate this? Same in this, we're gonna have, instead of receivable, they're gonna be my liability. So it means I will book, I have already taken the cash, I will do bank debit 10,000 because I have already taken the cash, and I will not do the sales, I will not book the sales because I have not given it yet, I will give in next 2 years. So I will consider this as a loan. Here I consider this as a sale, but here I cannot consider this as a sale, I will consider this as a loan. And then I will have to pay interest on this loan. Instead of instead of recording a net interest income, I will book a interest expense. Interest expense debit 1000 and credit loan because I will increase the loan value. By the end of first year, this is 0, this is year 1, and this is year 2. By the end of year 1, the loan value is 11,000, and again I will take 10% on this, it means 1100. So I will increase the loan value like this, I will increase the loan value. So interest expense debit credit loan. So by end of year 2 I will have 12,100 loan. So when I give you the service, on that moment, on this day, I will consider this as a sale. Then I will reverse this loan. So loan, when you these are credit, when you reverse the loan, it will debit. So 12,100, and then I will consider this as sale. That at this point I can consider that I made a sale. But here I cannot consider this as a sale. I can only consider this when I will deliver it. So I already teach you in two different aspects. Now let's do the next stage. Okay, we have already considered this price issue. Now the fourth stage is allocation of price. How we will allocate the price on different obligation. Okay, suppose I will give you example of generator. What I will do is, if I sell a generator, I will charge 1000. If I sell my maintenance, I'll charge 500 for 2 years. But if you buy generator and maintenance all together from me, instead of 1500 I'll give you in 1200. Separate standalone prices is 1000 for generator and 2-year maintenance is 500. It means 1500 standalone price. But as a combined price, if you take a generator and maintenance both together from me, then I will charge you 1200. In this case, how we will distribute, how we will allocate the price, how much from 1200, how much to take to generator and how much we need to take to maintenance. Now we will study how we will allocate. So add these two. If you add these two, it means 1500. So generator value is 1000, total is 1500, and price is 1200. You can see 1000 is 66.66%. It means if you calculate this, 1000 is a 66.66% of 1500. So it means we will allocate 66.66% to generator and 33.33% to maintenance. It means um, this will go to generator, which is 400 to generator, you can write it here as well, and 500 divided by 1500 multiplied by 1200. It means 800 go here and 400 will go to maintenance. It means out of 1200, 800 will go to generator and 400 will go to maintenance. And you can see generator, the moment I sell generator, it means I have given you the possession, I have given you the control, I have given you the generator, I have you gonna utilize the generator, you gonna have the benefit, economic benefit of from the generator. It means I can book the generator revenue on the same point, but for maintenance is for 2-year contract, so I cannot book this now. I will book this in I will separate this in 2 years. So first after 1 year I will book half of the maintenance. It means if I can show you here, 0, year 1 and year 2, year 1 and year 2. Here generator, I sell the generator and I gave generator, I give you the generator, I can book the revenue now. I will book it now. Generator, what I will do is I can book the revenue now, and for maintenance out of 400 I will book 200 in year 1 and 200 in year 2. I will separate this. How can I pass the entry? I will say debit cash. How much I received? 1200. I will say 1200 I have received. Out of this 1200 I can book only 800. 800. Where is it? 800. I will say I will book 800. I will book it now. Income, revenue, profit and loss. That to 400, that this 400 I cannot book it now, so it means I will book it as deferred income on point 0, deferred income of 400. After 1 year, what I will do is I will reverse this deferred income, debit. To reverse this, I will debit this deferred income and I will take this into profit and loss. 200 year 1 and year 2. I will separate this in 2 different years. So out of this I will separate this in 2 years. Deferred income debit and profit and loss credit in second year. So this way I can separate this. The amount which belongs to generator I will book on the same moment, but for deferred income I will keep it, and after 1 year I will reverse this deferred income, and in next to second year I will deferred income, I will reverse the next stage. So the last stage is book the revenue. This was the last stage. And how we will book it? Anything which we have given already, which we have no right on, like when being a generator example, you buy me you buy a car from me and I gave you the car. It means the car, I have given you the control, and you gonna use the car, you gonna take the economic benefit out of the car. I can book that car now, I can book that revenue now. And with the car I gave you 5-year warranty, then that warranty I will give, I cannot book the revenue for that I cannot book the revenue for that warranty. I will book that revenue by the time. If it is for 5 years, I will book the revenue in 5 years. I will spread in 5 years. So a standard says these are the hints that you have transferred the control. How we can consider that we have transferred the control? The first is possession has been transferred or control has been transferred. When we say that we have already transferred the control or when we have given the possession, it means it's a hint. Second is legal title. It means we have the car was on my name before and now I transfer it on your name, so it means this is a hint. The last is risk and reward or economic benefit. Like being a generator, it means when you buy a generator from me, you're gonna have a control, you're gonna have a title, or and the most important thing is risk and reward. You're gonna utilize all the risk and you're gonna utilize the rewards, you're gonna use the benefit. So this is the time you can get this. So these are the hints where you can get it. So this is the example of point in time, and there is one example how you can book this. These are example for point in time, these examples. Now I will tell you about some point in time over time. There are example where I can only book the revenue over time, not point in time, not simultaneously. It means where we are making a building, we have a construction site, so we have my team going to that construction site and we are building we are constructing a building there. So as long as these are constructed, it means it is coming in your possession. So this is overtime, like a service is overtime. So we will book the overtime, we will book the revenue of service overtime. Okay, now we will discuss the most important thing. Now we will study the construction accounting. It's very important. Okay, sometimes there are some legal or economic reality. Sometimes it's look like different, but the things are different. So I will show you the example. We will do this example, then you will understand. If suppose I have a iPhone, or I have cost of inventory, my inventory cost is 1000, the fair value of this inventory is 5000, but I sold this for 2000 and agreed to buy it back for 2200 after 1 year. It's what we will think. First thing come in my mind, the fair value is 5000, but why I sell this in 2000? Why is there any problem with my phone? Why the fair value is 5000, but I sold my iPhone for 2000 instead of 5000? Why I did it? And the second point is I agree to buy it back for 2200 after 1 year. I say I am selling you in 2000, but after 2 years, after 1 year, I will buy it back for 2200. If you can consider this, if you'll have a look, it means it's not a genuine sale because I am buying it back. So we will consider this as a loan. The economic reality has been changed and the interest rate is 10%. How we will book this? Now the correct entry should be bank 2000. It means this, I sold it for 2000. And I cannot put sales, I cannot credit sales because not a sale, it's a loan. So I will credit a loan of 2000. And after 1 year, this is 0.0, this is 0.1. So after 1 year, what I will do is, in the between the year, I will have to pass the interest, because any liability which is more than 12 months, we record these accordingly to the present value. So we will do the present value. So the present value is 2000 multiplied by 10%. The present value of this is 200. So in this way, I will have to pay some interest expense. So interest expense of 200, and I will credit the loan. So previously the loan was 2000, and now add 200 more, it means 2200. This is the price. So this is what I said, that after 12 months I will pay you 2200, and I have included interest effect in it. In F7, sometime the examiner made a mistake and he wants you to reverse the entry, he wants you to correct the entry, or sometime there are some entries are missing and you have to complete it, or sometime the examiner will test you in this way that he will omit the entry and then you have to pass it. I will tell you the entries now. So entry should be this. We have already studied it in F3, what had been wrong. This should be the entry, but what went wrong, and now reversing entry. So the examiner, I'm giving you example now. This should be the correct entry, bank to loan. But what did they say? What examiner said, bank 2000, but they consider it as a sale 2000. We should consider this as a loan, but examiner, I am giving the example. So in the question this will say we consider this as a sale. It should not be a sale. It means to rectify this, we need to pass a rectifying entry. We need to pass a rectifying entry in order to reverse this, in order to rectify this. So it means, if you have a look, bank is debited correctly, is debit here, is debit here. So there should not be effect on bank. Loan should be credited, but we mistakenly credit sales. Now we will reverse this. Sales, we will reverse the sale. It is credited here, debit the sale of 2000, and we should consider this as a loan, which we did not. So reverse this as a loan, and put this in a loan. So in this way you can rectify this entry. So it should be, this is the right entry. This should be the right entry, but this went wrong, and this is the rectifying entry. So this is the F7. Whenever you see the in question, you will have three stages. Either you will have to rectify the entry, either there are some missing entries. And consider this, whenever you book a sale, you have to book a cost of sale as well. Whenever you book a sale, you have to calculate the cost of sale. It means when you have considered the sale here, so you might you need to reverse that cost of sale as well. Now we will study the most important thing, construction accounting. It has 4 stages. First is compute the total profit. We will see. Okay, let's start construction accounting now. In revenue, if you're building a land, on the land, if you're building a if you're constructing a building on the land, then it gonna be in the stages. You will be suppose if you build, you will have to build level 1 first, and then you're gonna build on top level 2, and then you're gonna make construct level 3. So this IFRS 15 will tell us how much you can book revenue in this stage, how much you are allowed to book a revenue on this stage, and how much you can see how much you can put as a revenue, how much you can say that I have already earned this revenue at this stage. So first thing is we will study 5 different stages in this. So this first stage is compute total profit. So we will have to compute the total profit, and how we can pay the total profit, whether if it is profit, then book profit according to stage of completion. If the project is giving you the profit, then book it as a stage of completion. And if you are having a loss, and then book a full loss on the same moment. You need to book up loss because of the prudence concept. I'll give you the example. So for example, project 1 and project 2. In project 1 you have a revenue, you are expecting a revenue of 500, and the estimated cost is 300, means the profit is 200. Then you need to book this as per this stage of completion. But if you got the loss, here you got the loss, you are having a, you see you can say the fixed price is 500 and estimated cost is 600. It means you're gonna get the loss of 100. So do not wait for the stage, just book the whole loss in profit and loss. Okay, so this is the way we will calculate so total revenue minus estimated cost, because from the very beginning, like suppose if it is a 5-year project, so this is suppose level 1, level 2, level 3, this is 3-year contract. You said in 1 year I will make this much, after 2nd year I will make this, 2nd year, and on 3rd year I will make this. So this is 3-year project. On by end of 1st year, by December 31st, you will see whether this give you profit or loss. If it is profit, how much you need to take, how much you need to book as a revenue as per stage of completion. And this point you can say, on this point you can say that how much you need, how much total amount is, and how much you gonna spend. Suppose you made a contract as being a construction contractor, that you did a contract of 500, that in 500k I will build a whole building, level 3 building. And you will see that your estimated cost is like 300. It means you think that out of 500 profit, out of 500 sale or revenue, you can you're expecting 300 as an expense, so you think that you can make 200 as a profit. You see the material cost and every cost is just maximum 300 estimated, so you're estimating it. So in this stage, suppose if you have a profit of 200, then, and suppose if you have done 50% work already, so book 50% of this. If you have done 60% of this, then book 60% of this revenue, or revenue of this 60% of this. And then either you can take this, or the best thing is, sometimes make a difference, so the best thing is take a 60%, take a 50% on this and 50% on this. If it is if your stage of completion is 50%, if your stage is of 50%, take sale price, and then on the same time take a cost of sale as well. So if your sale price or sale revenue or sale price or revenue is 500 and you have done 70% already, then take a 75% of this plus cost of sale. Take a cost, if cost of sale is 300, take 70% of this cost as well. Then it is like with like comparison. Okay, stage 2 or step 2 is compute compute stage of completion. How can we say how much I have done already? How can you say that I have done 60%, I have done 20%? So there are two methods. One is input method, second is output method. Input method is cost incurred to date divided by total estimated cost. It means that you are thinking, you have already out of, you're thinking that 80,000 is the total cost for whole project, but and you have done 60, you have already incurred 60,000 already. It means 75% has been done, 75% work has been done. It means out of a total of 80,000, total amount is 80,000, but you already spent till date is 60,000, you spent it already. It means you have spent 75% already, or it means you have completed stage of completion, you have completed 75% work already. And the second method is output method. In this method, the formula is value of work certified to date divided by construction price. It means if the construction price, if I did a contract with you that I will build a house, and I ask you give me 100,000, I will build you a house, and I will after 1 year I say this is 2-year project. After 1 year I say I have done 60% already. How can I say it? Because the construction contract was 100,000. The construction contract was 100,000, and I said the work certified is 60,000. I can show you that this is a work which I have done already. 60,000 amount work has been done already. It means 60% has been done. Stage 3, if it is profit or if it is loss, book on revenue. If it is 60% complete, if you are having a profit, and you can book 60% of your revenue, and on the same time book a cost of sale as well. But if you are having a loss, book the whole loss. This is gonna be stage number 3. Stage 4, SOFP extract. Previous stage 3 we made profit and loss. Now statement of financial position. In this we will say the project is in is this project is our asset, or this project is our loss or a liability. So see, actual cost incurred to date. So formula is, this is fixed for every question, this is fixed. So actual cost incurred to date, add how much you have done, how much you incurred the cost, actual cost, add this. If you are having a profit, add a profit. If you are having a loss, minus loss. If you are having a profit, add in this, or if you are having a loss, minus this. And then minus progress billing. It means how much you have already received out of one. Suppose I did a contract with you for 100,000, and I say after 1 year I did 60% already. Can you give me like half money, or can you give me 60% money, because I have done 60% job already? So progress billing is, you can minus how much you billed, you already received the money, how much you have billed, how much you have charged your customer, how much you have got the price already, how much you have received so far. If it is in positive, if this value is in positive, then it means it is a contract asset. But if it is a minus, it shows a minus, then it means this is your liability. So I'll show you the question. Let's do the question now. It is best if you take a picture, and then because I will say move the screen, and I won't be able to go back on the screen. So it is best if you take a picture. So let's read out the question. Contract started on 1st January X5. Contract fixed price is 1200. This is fixed. Duration 2 years. It means 2-year contract. Estimated total cost after 1 year is 900. Actual cost at end of year 2, 1000. Okay, actual cost incurred after 1 year 600, and actual cost. How much? These are the estimated one, these are the actual costs. Okay, year 2 is 400. So it means after first year you did you spent 600, and after 2 year and the second year you're gonna spend 400. It means if you add these two you will get this. It means after 2 year you will have 1000 as a total cost. Work certified x5, it means first year work certified was 720. When it is completed 1200, it means after 2 years it will be completed. Okay, company is using output method. So I've already discussed output method. So this is a formula for output method, this is a formula for output method. Work certified divided by construction price. So let's do the example now. First thing is, what we do, we calculate is it a revenue or is it a loss. So total estimated, because we need to calculate estimate. So total price is 900 and the total estimation is 900. 1200 is the total price and estimation is 900. First step is calculate profit or loss. So okay, total revenue. What is the total revenue? Fixed price is 1200. This okay, minus total estimated cost. Wait. Total estimated cost 900 was the total cost. See, we were saying that after 1 year the contract the cost would be 900. So is it a profit? Yes, the profit, it means profit. Now stage 2, book revenue as of stage of completion. How much company has done already? So company is using output method. It's written there, company is using output method. So value of work certified divided by total contract price. How much total price? Into 100 into percentage. Value of work certified for x5, this value of certified 720. It means 720 amount work has been certified divided by total price 1200 into 100. It means how much work has done. Let's see, 60% work has been done. So you can now stage 3, profit and loss. So you can book the revenue as per stage of second is stage of completion. Second stage is stage of completion. Third stage is book a revenue or profit or loss. So 60% work done. It means take a we can take 60% of this and 60% of cost. So revenue was 1200. Take 60% of this and cost of sale minus cost of sale was total sale was 900. It was expected 900. Takes 900, 60% of 900. So it will be 720 and this will be for 540. It means 180. This you can book as a profit. you can book as a revenue. This you can book as a revenue. Now calculate SOFP, statement of financial position. So I already told you, calculate the actual cost. The formula was actual cost incurred to date, because this is for as at. So we make SOFP as at 31st December x5. So for end of year 1, by end of year 1, actual cost was 600. So actual cost was 600. Add profit, because it is giving a profit. How much it is giving a profit? 180. So add 180 less progress billing. Progress billing means how much you have done already, how much you charged already. So you can see 60% has been done. It means if you can take 1200, 60% 1200, it means this work has already been done. 720 you can take, because this is the work certified already. This is because this is the work which has already been certified, which has you already got the money for this. So if you take a balance, it means it's a positive value. So if it is a positive value, it means it is a contract. Contract is a asset. This is a contract asset. Let's make SOFP for next year. SOFP as at 31st December x6 next year. So same actual cost incurred to date, how much has already been incurred by the end of year 2. In this x6 is 1200, it means 1200 sorry, let me see, work certified, oh sorry, it was work certified. So by end of year 2 the cost is 1000. The cost is 1000. Now add profit to date, how much you have taken the profit to date. So the profit you take is 200. How much you have taken less progress billing, how much you have already charged. It means by the second year you will have completed your work. It means you have already done all your job. It means the total price must have been recovered after 2 years. So take 1200. So by the end of this, it means that after 2 years there is no more contract, so no liability and no asset, because after second year the contract has already been performed, it has already been done, so it's already been over. That is why you will not be able to see any liability or asset. This is for first year x6 x5. Let's make x6. So the total revenue is 1200 and your total cost is 1000. So it means you will get 2200 as a profit. So if you see, this is for as at, but if you want to extract for the year, if you want to take it for the year, just take a difference between these 2 years, then you will have for the year, because this is first year and this is after the completing the project. This is the period where you have done or you have completed your project. But if you want to take for the year profit and loss, then take a difference of these two, both the years. So revenue was 720 out of 1200. Out of 1200, 720 was belongs from the previous year. This belongs from the previous year. So take a 480 is the this year. In second year, the second year profit revenue, and total cost was 1000. Out of 1000, last year cost was 540. So it means for this year the cost was 460. So you can say 20 profit is for this year. So you made 20 in this year as a profit, out because you made 200 in total. Out of 200, 180 was from the previous year, and this year the total profit is 20 only. So this is the way you calculate your construction question. If you feel like I moved fast, you can pause the video, you can watch it, and you can come again. Let's do this example. Contract started January X7. Use life of the contract 2 years, 2-year contract. Total revenue 40 million, and then total cost at end of year 1 is 25 million excluding depreciation. It means depreciation is not included. Actual cost incurred 1 year. After 1 year, actual cost was 10 million out of 15 million, and excluding depreciation is not included. Actual cost after 2 years, 28 million. Depreciation is not included. At beginning, company bought a machine for 3 million. It means for this particular project, company also bought 3 million machine, and company is using output method. Value of work certified is 24 million after 1 year, and on the second year it means the project has already been done. So the second year the work certified amount will be 40 million. Okay, let's do the please do take a picture, and then I'll move the screen. Okay, let's move it. So first step is whether it is profit or loss. So total revenue minus total estimated cost. Total revenue was 40 million. Okay, total estimated cost is 25 plus, because company bought 3 million extra machine for this project only, so it means 25 plus 3. So total cost profit is, so you can say the profit is 12 million. Now let's do this second stage of completion. How much work has done, and company is using output method. Output, it means value what was it, value certified divided by work certified, where it is written here, value of work certified divided by total contract price. Okay, so output method is value of work certified. So value of work certified till the where it is written, I must have wrote somewhere 24, yeah, this you can see value of work certified 24 million. Total price was 40 million. It means how much work has done, 60% work has been done. Multiply by 100 to make it 100. So 60% has already been done. So you can take profit and loss, and you can book a revenue 60% of your total price. Total revenue was 40 million. Take 60% of this. I need space. I need to write something else for you. total revenue was 40 million. Take 60% of this, which is 24, and then total cost was 28. This total cost is this 25 plus 3 million extra machine. 28, take a 60% of this, so total cost is 16.8. so it means you can take this profit in profit and loss in this year. Profit and loss for X December X7. Okay, now the fourth stage. After this we calculate Sofp. Sofp is really simple, as at 31st December X7 first. Okay, so cost incurred to date. How much the cost has already been done? See, I'll show you. 10 million. See, 10 million cost has been done till first year. So 10 million plus, because the cost was because we have added machine, 3 million machine, and depreciation. We need to take depreciation effect as well. So how we calculate depreciation? 3 million was a machine cost and life was 2 years. It means 1.5 as a depreciation. So we will add in this. So total cost incurred is 10 million for the material plus 1.5 million for the depreciation. So this will be your total cost. The total cost is 11.5. Now add a profit. Add profit to date. How much you made the profit already? So this is a profit you made. So add this 7.2. How much you made? 7.2. You already made the profit. Less progress billing. How much you work certified, how much you have done already. So this is the work you have done already. So 24. It means 5.3 negative. If it is negative, then contract liability is a liability. Yes, a contract is a liability because you're not making profit. It's not an asset. So let's make this is X7, now X8. Let's make X8. Total revenue was 40 million and total cost was 28 plus 3, which is depreciation. So it means 25 is a total cost. This 25 is a total cost. 3 is 3 million which you bought a machine, and plus by the second year it will have no zero as scrap value. It will have 1.5 depreciation for 1 year, 1.5 depreciation for the second year. So this is going to be the total cost. If you minus this, it means 9. So you will have a profit of 9. Now we will make for the year, because this is as at for the year. Now we will make for the year profit and loss. Just take a difference between these two. Take a difference between these two. So it means out of 40 million, 24 million was belongs from the previous year. This is coming from the previous month. It means for this year your profit total earning is 16, and the total cost is how much total cost is 31. So 31 is a total cost. Out of this 31, 16.8 is from the previous year. It means for this year the total cost is 14. So it means 9 total profit you made is 9. Out of 9, 7.2 was from the previous year, and 1.8 is a profit for this year, for 2000 X8. This is X8 year. Hopefully you get these points. So if you feel like I was going fast, you can pause the video, you can go back, and you can come again. So this is the way you can calculate everything. And stay tuned, I'll make more videos in the coming weekend. See ya, bye.